as of late. I've been following it closely. I've been trading it with a few clients so far that, and it seems like a very viable new futures or relatively new futures contract. It also trades in a exchange traded spread to the pork cutout, or the pork cutout to the lean hogs with the premium to the pork cutout there. So the December hog cutout spread here has dropped considerably. We found ourselves down to the tightest levels we've seen in this cutout to hog spread really all year. We have to go back to last year to get to prices where we are. So, are we making a new normal for the hog complex? Are we finding new margins for our, for pork production here? Possibly. I think some of the drop we've seen in the pork cutout is in direct response to some of the news we're seeing out of China, the massive increase in their hog herd, and a general lack of strong pork exports. I think because China has reestablished their own domestic production at this point. That doesn't mean that we won't see sales. They always have to offset that. There's certainly other countries in the world where we are trading partners with, but we're seeing a squeeze on production margins for hogs right now, well, for pork, and that pork cutout to lean hog spread here, again, getting to its tightest levels here all year. I do think we're starting to get to an extreme maybe on that here, and I would be looking maybe for the market to trade back towards that 10 over spread that historically we've been kind of sitting at with a margin of about 10 there. Okay. All that being said, let's look at the underlyings now. Outright December lean hogs here had quite the recovery day yesterday. Follow through today of higher highs and higher lows. We're really, though, just back into retesting the old support here that we had held since the end of October. The 100-day moving average and 55-day moving average and 18-day moving average are all pretty close here within a point. Actually, throw the 200-day in there, a point and a half from where we're at. Actually, within 2.1 points, I guess, is we have all four of our major daily moving averages clustering up here. Hogs had a pretty dramatic drop there at the end of September and into October. But we've seen a substantial recovery, and we are really just back into the range 82 to 88 that we've been in. So the broader, bigger picture, still very range-bound, and we have a market that's now pressing against trendline resistance, right? We have a confirmation, an outside day to the upside. We're still only, recovering this bearish, bearish breakdown or gap and go level. And we still have it, arguably an open gap on this chart somewhere in that 83.70 area, which if we pull up the more smaller time frame, I don't care about Tesla right now. Come on. I was actually looking at Tesla today to see how they performed. I'll get to that in a minute. So blow away the case. We'll blow away the feeders here for a hot second while we take a look at this hog chart. There we go. So yeah, 4-hour trend right now, still definitely pointing lower. You can see it almost a trend channel here that we formed to the downside. Sorry, let me flip the screens there. Downward sloping trend line, as I mentioned there previously, comes in now. We drop from the 89 high down through these prior highs. You can see that the resistance level that it had performed on this chart. Back above 84 is the confirmation of the break there. So filling of this tiny little itsy bitsy gap right here on the chart. I know, yeah, we traded into the lows of the prior day. So is it a gap? Is it not? I don't know. I constitute this, though, as a price gap because we closed at one price and we opened at another. And we really didn't trade into that area. Well, not only is it a gap, but it also is like 3 weeks worth of support for the hogs in that consolidation we saw coming into this late this year. All right, in the near term, it looks like it gave a little bit of a pullback here today. That 82 area held as support, so follow through and a tested 84 into tomorrow's morning might be the case. I mean, that might be the high, that we had today. Could be if we're not going higher. But I expect to see tomorrow's open put pressure on the 84 handle if we don't just go like straight down, which when you take a step back, the 50% swing from the 72.97 half low up to the 89.72 low, this looks like a pretty impulsive move higher and a three-wave structure lower. A, B wave triangle, maybe a C wave, A, B back up, C down, however you want to count this. It looks corrective to the downside in the channel, and we have resistance that would go above 84. There's a very, very high likelihood that it could, continue on with a $10 run towards 94, that upside target from the 81, 50% level that's holding. So if hogs are getting a little more bullish, let's look at the pork cutout real quick. We'll get into the row crops and everything else here in a second. But last few weeks, we've given so much attention to those where arguably they didn't really deserve it because there's just nothing to be said. Pork cutout also had kind of a three-wave correction down. We're much further away from our moving averages here. And if hogs are going to rally $10, this spread between porks and the cutout and the lean hogs here is probably, it's probably a reason why it's starting to come under a little pressure here, right? Because maybe the hogs are starting to find a bid, which means, you'd think, cutouts would potentially lead in this event. But again, we're talking about tightening of margins here on the first of the month into the end of the year. Seasonality from that standpoint, to me, says there's a lot of spread trading. There's a lot of commercial interest rolling their books and their positions. There's hedge funds getting in and out because it's the last month of the year that have no business in these markets other than speculation. You have a wheat market that is wildly short right now and is, in my opinion, really, really, really has all the potential energy in the world to stage a nice rally for a couple reasons. We'll look at those in a minute too. But for the time being, the pork cutout has been, smacked down, to the tune of $2 to $3 more than our lean hogs, and so that spread narrowed from 10 to 7. If the pork cutout can turn this bullish engulfing candle that we had yesterday, get follow through. Today was a really nothing day, but we held on to yesterday's gains. If we follow through the upside, get through 92 and all the way back to testing our 18-day moving average, 55, 100-day, and 200-day, respectively above us, I could see how that spread could then also, come back, towards 10, and get towards, move back from this 7 area, this low end of the range that we've been in for the last month, and head back up towards its own test. So we'll see what happens there. Wanted to at least point that out to everybody because, hey, it's an interesting. It's interesting if we can't really figure out what's going on in the underlyings. Sometimes these spread markets really shed some more light onto things where we can find more of an edge, so to speak, or find an edge. All right, keeping on the course for our protein markets here, let's take a look at the feeder cattle. We're of course moving everything out to the Feb at this point. It's one too many F's. And right, there's no Feb. Sorry, we'll just throw up the continuous. It works. There we go. Okay. So our feeder fats, also interesting dynamic here going on. I don't know, livestock. Flip over to our other chart real quick. 200-day moving average, big resistance level today for the feeders. 181.43 at 60. They're at the highs of the day, just a kiss of that level. 100-day moving average is above us, 182.73. That's certainly been the resistance, from the range we've been in since October. 18-day and 55-day moving average are now below us. We had that bullish crossover of the 18-day above the 15-day moving average. That is a short-term trend switch indicator that we utilize. And so, if we can push back above 182, 184, okay, maybe it can sustain a rally back towards 190. My problem is that when we switch over to look at our fat cattle chart here in the Febs, how much more room to the upside do fats really have? There has been considerable selling pressure for the entire year at 155 to 158. I would not be surprised to see, us capitulate through this level, get a blow off top type of move above 158. Might allow for that rally in the feeders as well. But is it enough to drag the feeders aren't telling us that they're looking like they want to go back to highs. If feeders are the leader here, let's bring up the 4-hour chart of our Jan feeders. We're still holding a 50% short off of the 191.50 high to the swing low after. That comes in at about 182. Sorry, my charts are switching over here. 182.42. That again was pretty much resistance there into the end of October and into the end of November. We're coming up for another test of that level, and unless we really, in my opinion, really break through, make a way up towards, that 184 and above type of area, break the 61.8 lines. We may go up there for, oh, this is weird. Don't know why things crashed on me here. Hold on. There we go. All right. Love technology until it stops working for you. So anyway, as I was saying, this could be all part of like a C wave of a 3-wave structure, corrective structure higher, right? So if this is impulsive down for the feeder cattle, if we're making, again, look at the daily chart here. If we're making a bit of a head and shoulders type of pattern, ignore some of this unrighteous price action when we were liquid. But, the resistance we held May through July is kind of that right shoulder, and we've got that neckline somewhere around 173. This is just the Jan feeder contract, right? Not a continuation chart. So it's interesting to see that we've really been range bound in this chart for the entire year, and that below 173 opens the door for just much, much lower prices. To that point, above 182, 190, 150 isn't out of the question, but again, feeder cattle losing a lot of steam up into, fat cattle losing a lot of steam here up into resistance. And today being a down day, which for the live cattle at the very least was, more or less confined by the 255-day and 100-day moving averages as support over the last month, the lowest, and now the 18-day moving average kind of being the short-term support. So we're stable 154 above lows of today and above the lows of the last 3-4 days. Maybe we got a chance of going higher, but we start to break lower, we'll be retesting all these levels. And if we've lost that steam in cattle to go higher, and certainly if cattle going higher, we're expecting these grains to go a little bit lower, or could expect them to go lower, it might be the short-term trend, for the next couple days. But if we find support in row crops and resistance in cattle, we could be right back to where we were. All right, now let's get into those row crops, because starting off with our January soybean, this was the news. This was the real mover of the day. It wasn't as much the beans as it was like bean oil. So let's start there. Bean oil down almost 10% today. Completely crapped the bed. Much of this, in my opinion, is due to the recent EPA announcement. We all were expecting a very bullish report today from the announcement from the EPA, increasing biofuel mandates. It looked like the Biden administration was pushing the EPA to, throw one the way of agricultural producers this time, which is in stark contrast to how the administration handled their, the biofuel mandates at the beginning of their term, which was very much a catered, handoff to big oil, in my opinion. They reduced and walked back on mandates at a time when oil prices were rising, and it made no sense whatsoever if you're trying to bring inflation down to not find alternative fuel solutions to try to meet that rising demand. All that being said, soy oil completely falls out of bed because the EPA has now lifted canola and rapeseed production to on par with beans. So canola oil is now on par for quality and premium as with soy oil in this biofuel mandate, basically putting soy oil in direct competition now with canola, which anyone that knows anything about the production and where canola is primarily produced knows that this is not a win for the United States. This is a win for Canadian canola producers. This is a loss for U.S. soybean producers. This is a win for U.S. electric vehicle producers and a win for RIN traders. Everyone else lost out on this new mandate. Even though it is increasing biofuel mandates, corn certainly going to benefit from that. It really did a number on the status quo for what we are, or how we produce biodiesel today. So how that's going to shake up the industry and change things up? Well, I think a 10% move in bean oil is certainly the start of something, and to the point that it can really become an alternative to bean oil in biodiesel. Leads us to a lot of other questions, about trade, the NAFTA deal with China or with Canada, and other, trade imbalances now that we need to consider. All right, so bean oil takes a dump. Soybeans by proxy, also the big loser on the day. Technicals on the beans were looking pretty good. We were getting above that 200-day moving average at 14.49. Good look. We were above the 18-day moving average again, and then we even came back to test it today. And hell, we're holding around that 14.40 to 14.50 area for a little bit before really just falling apart again. And when I say a little bit, I mean there is a very small bounce there, but okay, somebody was trying. The 100-day and 55-day moving average is still down around 14.22 for that 55-day and 14.17 for the 100-day. Pretty much the support we ran into today, and the support that held all through the end of November, and the resistance that we broke out of in October. So does this end? Is this the end for soybeans? Not quite yet. As massively bearish as today was, we haven't actually broken trendline support. We haven't broken below all of our moving averages. We've come back down to test an old support level and an old resistance level. And we really have, since October 31st, found ourselves in this 1420 to 1475 range. So was it, it's a bad down day, no doubt about that. But is it enough to think that we're going to like $12 beans? Not necessarily. I will admit, I don't think any of us analysts have done enough to work through how much canola can impact soy oil demand. And once we really hone in on that number, I think we will, stabilize a bit more in price. But the downside we're seeing massive participation in put selling. We saw, in these big breaks, we're seeing, and from sources that watch this stuff more closely than we do, are calling out that they're seeing 500 lot at the money puts being sold. That's a very confident buyer, and a natural or a real buyer, commercial buy entity, China, possibly, right? China, in here influencing our markets. Now, we have seen this pattern in the past. In fact, this is the same pattern, and full disclosure, we need to, look at this as, realize we're looking at one, type of trade in a vacuum here, right? But it's a very big commitment of a trade, right? Selling any option in and of itself is the most risky thing you can do in futures trading and futures and options trading, because you have unlimited risk. You have all the risk of owning a future without all the upside of potentially what a future can give you, essentially. If you look at, the raw risk over the whole life of that option. Of course, the delta on it, swings that and changes that daily. But the point being is you still have, in theory, unlimited risk. And this player is willing to commit 500 at the money puts to saying, I think beans are going to go higher. This same type of pattern is what we saw last year in this market cycle. The big, massive breaks we'd have would be very quickly rallied back up within a day or so. And we saw massive put selling in these big breaks, where big committed participants are getting their fill. And the idea there is, right, if an entity like China comes in and sells a 1420 put into the end of the day, or 1430 put, they're perfectly happy owning the soybeans, right? But they're getting paid all that premium to do so. And then if they are a really savvy hedger, they might be shorting futures against some of their cash purchases as well. So you can't underestimate how savvy of a trader our export partners can be. But we do see, some we're at least seeing some hints, right, of really committed participation on this dip, right? So there's volume there wanting to be a buyer, which is interesting to see. Okay, corn, December corn finally breaks below that 660 area and stays there. Test the 650 today and a close right on the figure. Puts December corn into quite a predicament into its, delivery period here. March corn fared a little bit better. I think the only reason we saw an additional 6 cents selling pressure out there on December is because it's in first notice. Switch over to March, and we really didn't break anything of note. We're still above 660. We're in the range we've been in since November started, or mid-November, in this little bear flag, unfortunately I got to call it. But we haven't broken below the resistance there that we broke out of in August. We're still holding right at that 100-day moving average. Granted, we're below the 18-day, 200, and 55-day moving averages now. But there is still a little glimmer of hope, right, that it could hang on. Unfortunately, though, I do think that we're going to probably see a little more momentum the way we closed today in both beans and corn lower. For the soybeans, something I guess I just need to jump back on real quick because I did not mention this, kind of my outlook or forecast here. When we take a step back on that 4-hour chart for soybeans, we have banged into that larger resistance above. We got open gap above at 1538, open gap down at 1350. None of this is new. This stuff's been on the chart since August. We've just been going sideways listly in this range. The 50% at 1415 is interesting because it looks like we're going to get a second test. There's certainly an upward sloping trend line against the lows I mentioned here. Trend lines, I don't know. I have a love-hate relationship with them. I think we all do. But they're worth having on the chart until it breaks or holds, and it's something to talk about later. This 1420 to 1400 area is an inflection zone. It's a supportive zone. We're certainly down into the low end of the range that we've been in for the last several months, and we have upward sloping trend lines that, in theory, I think should keep us above 1400. But should we see another test at that level here in the next day or so, and then a subsequent maybe start of a relief rally off of it? And again, the key there is a start of a rally off. Like, I'm not one to catch a falling knife with futures here. I am talking, and it alluded to, looking at options and option call spreads in this dip to maybe position for a move back above 1480 or 1500. That means we're buying a 1480 or 1500 call, and then we're looking to sell, a 1580 or 1600 above to help pay for that between now and like March or May of next year. Because again, if we're going to go through the same pattern of export markets and then seasonal trend higher, there really isn't any reason we shouldn't expect to see another test above $15 for soybeans at some time between now and May. And that type of option strategy allows you, the trader, to know exactly what your risk is up front, whatever it costs you, that's it, and gives you a lot of time for that, for that spread to come to fruition. If we're wrong and beans head a little lower, we're short a call that we can buy back later and maybe even roll that long call down when we think support is in fact finally has held. But end of today, we found ourselves at support in many of these markets and all of our row crops, and I'm fearful that we'll see some momentum through tomorrow. But then going into next week, if we haven't broken down even further and seen real follow through, we're still very much in a range, and we're just range trading lower at this point. So maybe this is just going to be a slow December. I don't know. All right, back to corn. So again, that March corn still in its little bit of range. It closed down on its low at 660. So let's just flip over to the 4-hour chart here. I'm going to flip right back. Great. There we go. I'm actually a little shocked we didn't see more of a recovery here, at least to get to 682, the full 50% short off the highs at this point. So, but because of that, the 768 high down to the 568 low, right? The last rally we saw from July through that November high in corn, that broke the 61.8 line at $7. Right? So we effectively invalidated that type of setup. So now the ambush, 50% long, drawn from the low of the previous failure to that new high that broke the 61.8 line of that previous failure, has a supportive area of a 50% line at 640. Okay, let's do it. Let's trade 640 on December corn. Trade a nice little halfway back ambush long. There's still an open gap down here on the March chart at 589. So again, this is the supportive area and the inflection zone between 630 and 645. Old high, old high, old high, right? This 50% supportive area, the cluster that we broke out of, we broke out, we found new resistance, we come back down to test support. Just price discovery. Take 2 steps forward, 1 step back. I would almost welcome at this point just to clean up the chart, get a capitulating slide down, and then a rally off that level. And if that's going to be the case, what I was talking about before, a big reason why, maybe another reason why soybeans couldn't rally and sustain their rally that we saw over the last couple of weeks is because corn has just quite frankly said, no, I'm not going any higher. When beans were up testing at 15 and corn was testing towards 7, the bean to corn ratio, right, throwing it out there, 1480 divided by $7. We know it's, just over 1, but I want the exact number because, 2.11 is the ratio there. The point being is because we saw that ratio when corn fell and beans were still up at 1480, right? That ratio fell as corn did here down to 660, and that ratio rallied, all the way up to about 2.5 to 2.3. The widest we've really seen this go is like 2.5 to 2.7 in some really extreme market conditions, but that corn to bean ratio usually hovers between that 2.0 to 2.15 area. Going to 2.2 to 2.3, we're starting to stretch the envelope a little bit, and beans, quite frankly, weren't enough to pull corn and wheat higher. Wasn't pulling corn higher, and corn wasn't also going higher because corn was probably being pulled down by wheat. You look at the corn to wheat ratio, well, quite frankly, they're almost at 1 to 1. They're almost, we have to wonder, is wheat really going to trade to parity with corn here? I don't think that's going to be the case. So, if that's what the market's telling us, it means corn can't go higher because of wheat unless wheat comes higher, and beans can't go higher unless corn comes higher. Just watching the ratio, or just talking through the ratios, right? Gaming out how those ratio spreads have worked over the last, or how they've been bullied around, so to speak, going into the first week of a new month and seeing a lot of other spread trading going on. The pork cutouts, feeders and fats, porks to cattle, all of these spreads that have dislodged their correlations and certainly been some of the catalysts for the moves we've seen recently, could be also in effect happening in an intercommodity spread here between corn, wheat, and beans. And quite frankly, if they can't all align and get their act together, and there isn't a single driving news force in one that would, allow the others to do their own thing, like for example, the the start of the Ukrainian-Russian war was a big wheat-centric issue, right? That's why wheat saw, the immense run-up it did, in essence, leaving corn and beans far behind in terms of just raw percentage gain. We don't have that kind of dynamic going on right now, right? The crops have been made. We know what supply is, at least from North America. We know what export expectations are. According to grain stocks are coming down the road. We just had a new EPA biofuel mandate, which means all of us analysts have to go back and rework our balance sheets now because that demand is now different. But, in essence, right, we're at that time of the year where these things get decided. All right, so what else can we talk about, or we want to talk about today? Let's move on to cotton. March cotton here had a limit up day yesterday and then a bit of a doji close. Not getting the follow through you want, but this was, in my opinion, right? We've been talking about cotton. Oh, let me flip over the chart. Sorry. We've been talking about cotton in this decline, and we were wanting to see, a reversal. We saw that reversal happen. We got back above the 18-day moving average. We talked about, look for the market to come back to test those areas and maybe buy a pullback. 50% retracement from the low to the high here. 5618 line trades and holds. We've got an open gap below us at 74.80. That is we're in a gap and go situation. So now it's my opinion, cotton now on a move above 87 is very likely going for a test back to at least 90, so that 55-day move or 100-day moving average, and very likely, in my opinion, back to the middle of the range from 125 down to 70, which is right where our 200-day moving average is at 99.50. So I think cotton is a potential breakout buy here. We've moved above the 55-day moving average. We moved back above the 18-day moving average, which is the buy signal in this type of idea. If we're using the 18-day moving average as a core swing reversal entry, we're back above it. And even today's price action arguably came back down and tested it. We have also now had the golden cross again of the 18-day above the 55-day moving average. A similar move that we saw in the feeder cattle. That again is a short-term trend turn indicator that we use in some of the many of our markets. In fact, you see it on all of my charts. And we can continue to monitor it here to see if it heads higher. All right, so we've got what I would refer to as a buy signal on the chart, and I think as long as we're generally above 77.50, I think cotton is probably heading higher towards a test of 95 to 99 at this point. It's going to be really hard, as I was talking to some of my cotton guys, actual producers down south, talking with them today how hard it's going to be for guys to put cotton in the ground this year. Just too darn expensive. And with beans at $14 and corn at $7, and wheat's not really competitive there. I think down at below $8. But okay, if wheat goes back to 9 or 10, I think a lot of these cotton acres are going to disappear. So cotton needs to buy some acres here. We use this terminology in our other row crops. There's no reason that cotton at this point, cotton prices shouldn't rally to buy acres. You're looking to do reownership right now. If you were savvy and you got sold there above 100 and in that rally, I think this is a great opportunity for reownership now, or to start lifting some of the short side hedges if you haven't done so already. Call spreads in the cotton would be a preferable maybe strategy here, and that's mainly because let's see here, CT, because of the wild volatility in this market, right? So our March cotton at the money call is going to cost you $6.90. That is a pretty penny, but we cut that cost dramatically down, almost in half, not quite. Make it a $10 spread by selling the 240s. Now, I personally would maybe go a little bit higher on my strike, maybe take the 88 or not even 90 strike and turn it into a $10 spread. Good one here that I'm interested in, 71 days, 90 call, settled out at 465, 450, 465. It's where it traded last, okay? Not a great barometer for it, but that's okay. Turning around and selling a 970, turning a $7 spread for about $2. I think over the next 71 days, that's a great risk-reward ratio in terms of what we can look out for in cotton. Because if you don't love watching cotton, or if you're not used to it, it's a very strange futures market to trade. It goes limit more than anything else I've ever seen. And if you're not used to that type of futures trading, option strategies like call and put spreads are where you should live. The outright calls and puts can be very expensive because of the volatility, but that's where just use a put spread and you can have finite risk and good ratio, ratio risk reward. Okay. Last but not least, I got it, metals and crude. Crude real quick. Breaking out of the downward sloping trend or channel that we've been in for the last month or so. Serious rally here, $10 rally basically off of the 74 low. We're down into the area where the Biden administration had commented previously that we would be below 80, breaks below 80 effectively, would be places that we'd see the strategic oil reserve start to get replenished. Is that what's happening here? Is that part of this bid, this relief rally? Well, okay, I mean, get rid of that could be one idea, but another idea is that we're just pulling halfway back short for the month of November basically. So from that 94 high down to the 73 low, guess what? Trading to the 50% short here in the crude, and I think we're really in a bottoming process still. Can we go lower? Yes. 68 is the bigger, much bigger 50% long now from the COVID lows to the highs after. So maybe we just need to tag that 50%, but we're certainly getting close enough to it, in my opinion, to where this $20 range between 75 and 95. I'm bullish above, bearish below at this point, because this is the fight over the macro trend in crude that I think we're seeing. There's a lot of other trends that in crude and things that are going on with taxes that also could lead to inflationary pressures, but that's a story for another day. All right, we'll close out today with a look at our precious metals. We're going to be covering them a little bit more closely because I think gold and silver have come back to life, and we finally have the market cycle, we have the bond market, we have risk assets, everything's aligning to where I think we're going to see a beneficial, 2023 for for silver and gold. Yeah, it's easy to say when we're $215 or $200 off the lows in gold now, but this is an idea that we've been talking about for the last month or so, or maybe going back further, since really July, talking about how into the third and fourth quarter, the recessionary slowdown in the U.S. is going to put a hamper on risk assets. Gold and silver are probably going to fall alongside everything else. But then in the first quarter of the new year, when we start to re-examine fiscal policy, when people just generally get upset with the fact we are just printing money and the only way out of all of this, again, is just printing money, gold and silver come back as favorable things. Now now that we've seen the bubble burst in terms of the speculative bubble that grew into the 2020s, right, is totally popped in my opinion, right? Everything, Bitcoin, everything has collapsed. Everything that was risk associated has gone through some kind of correction. Gold and silver will oftentimes follow that selling pressure, but then will become leaders off of the lows in these times of uncertainty. And it's almost counterintuitive because a lot of people go into this thinking, oh, when the stock market goes down, the gold and silver are what you buy to be safe and they'll go up. Well, kind of, sort of. There's other things that need to occur, treasury markets, certainly in public perception of currencies, and other shifts that need to occur to get that excitement back in the metals, okay? So we'll see. 50% retracement from the highs to the lows for gold, 1850. It seems like we are coming up quick to test that level. Looks like into tonight and tomorrow we'll be seeing who's home and if anyone's willing to try to start a bear market in gold. But arguably this has been a 3-wave correction, an Elliott wave flat correction if you want, into a bit of a front run of the 1566 50% long from the 1042 swing low to the 2089 high. But hey, what's $44 among friends in the gold? But what we did test into was this inflection zone, the fight over 15 and 1600 that occurred back in February of 2020, the breakout that occurred with COVID. We're back to testing those levels in gold, and we're holding them. We're not just holding them, we rallied 200 points off of the lows or off of the old resistance and the levels that we fought over post-COVID. So inflationary move happens, then the risk off happens. They caught a second inflationary little love burst there. Then more risk off happened. And now that the market, at least in the metal market, seem to have wound out their own period of price discovery, I think are starting to set a precedent for themselves. So does that align with what we see in gold, silver with silver? And then we'll look at treasuries last, and that will be it. I'm just adding stuff on, I know. Fun day. Silver, too, coming back to life. I personally wanted to see, I was really hoping we'd see one of those big flush outs down to like 12, to like load up on physical. And I'm a little disappointed that I did not do anything in this last move down below 20. I told myself I would, and then I didn't, so now I'm a little cheesed off about that and having, now needing to pay $3 more in cost for that position, but so be it. For those that don't know, too, Zaner is, in fact, a precious metals dealer as well. So if you're ever interested and anyone wants to have discussions about spot and owning spot and having physical delivery, we're the guys to talk to for that as well. So gold catching a nice rally, silver doing the same, pressing down into its 61.8 lines. Okay, it's a very choppy move to the downside. The 50% retracement, though, from the 30 highs down to the 1740 lows for silver, 23.95. And we're at close today here at 22.92, or trading right now at highs at 22.92. So $1 away there for the silver to be testing back to its 50% level off of its highs, as well as this cluster of all this old support that we'd held for most of 2021. So silver's usually a little bit slower to start, but then it's the grand finale. Once the excitement begins, you won't be able to get into silver, but it will be, usually in my opinion, is the dog at the start of these things, and then all of a sudden at the end you're like, wow, how did I not just buy some silver? I was just doing this thing. I was just buying gold, and it was working out, but whatever. All right, last but not least, let's look at that 30-year note. Because the 30-year in gold markets have extremely tight correlations. In fact, out of every intercommodity correlation you can look at, gold and the 30-year are one of the highest. I'm just going to do a quick compare with study. Custom symbol here because we're throwing gold in. You don't even have to do anything to right? I didn't have to do anything to readjust the levels of these charts to make them align, right? Boom. So if you've never seen this correlation before, it's definitely one of my favorites. My other favorite is the 10-year and the Japanese yen, which also correlates with this. So it's somewhere else to look. But if gold certainly just took off here, right? Well, oh man, got a chart here that has a lot going on, but we're in an uptrend in the treasuries, and the 50% swing from 145 down to the 117 lows is at 131. 131 level, we go back. It's the old support there from May, June, and then broke there in September. So we're coming back up to test old support as resistance. We also, on the daily chart here, have trendline resistance on the treasuries against the highs here. Oh, this is an awful chart. I am so sorry for how painful this is for our eyes right now. But it's this dotted trend line against the highs, because I'm just throwing the 10-year. I'm throwing this all on my S&P stuff, so that's okay. 133 is where that comes in. So this 131 to 133 area is still the resistance zone. I will be looking for some selling pressure potentially to come in. Not necessarily going to step in the way of that freight train, because above that 133 high, we're going back to 145. In the bonds, and that's going to take gold back to 2000 and above, in my opinion, and at least from what we're seeing right on the charts right now. Gold's certainly leading the way, and I think Treasury's got more upside now, seeing this move in the precious metals. So, all right, that wraps today's Strategy of the Week webinar. Thanks for joining me, everybody. Remember, you can always be got in touch over here at Zaner at 312-277-0110. Shoot me an email. Find me on Facebook and Twitter. And also, if you're joining me on the Facebook live stream right now, you want to be a part of this webinar, get the email and video recording sent to you. Sign up. It's totally free. The comment section and information section of this video, as well as our Zaner Ag Hedge daily newsletter, if you're interested in getting that as well. So have a great day, everybody. Have a better weekend. I'm Dan Hussey with Zaner Ag Hedge, and we'll be back with you as price action develops.